This is the current federal tax developments for the week of August the 4th, 2025. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollars, and I'm coming to you this week again from Phoenix. And what we're going to talk about here in the rather hot Phoenix are a number of developments that took place this week. First, we're going to discuss the commissioner's announcement that filing season is forecasted to begin in mid-February this year, so it'll be a delayed. Not surprisingly, the One Big Beautiful Bill Act is the reason for the delay, and we'll talk about what that impacts and what concerns we have based on that. Secondly, we'll talk about a court case where settlement proceeds were found to be taxable, and the taxpayer got stuck with late filing penalties because of that. I'm going to talk about the IRS issuance of relief for corporate alternative minimum tax situations where there are partnership investments. So we'll talk a little bit about that, how they are essentially pulling back from proposed regs issued in September of 2024, and they're going to release a new, slightly different set of rules. We'll talk also about a case for corporate merger and whether and how the same taxpayer rule for interest nettings, where you have a deficiency and an overpayment running at the same time, works when you merge two corporations together. What if there are deficiencies and overpayments from years prior to the merger? Are they still the same taxpayer if that liability continues to exist after the entities have been merged? We'll also talk about what's an educational organization for the unrelated business income tax purposes for the exclusion for debt-related items. So we'll talk a little bit about that for that background. We have another micro-captive arrangement that fell apart under court challenge. Talk a bit about that. And we also have a taxpayer who claims she didn't consent to the filing of a joint return, but the court found that didn't impact the denial of innocent spouse relief for various reasons, and so one of which is she's only asking for relief being an innocent spouse, but you can't be an innocent spouse unless you file a joint return, and you also can't really get relief for what's your own income. And it turns out that both of those were a problem. The court really didn't care, said regardless of whether you did or didn't agree to file a joint return, you didn't file any other return. So you still owe tax on this. It just, depends on how we compute it based on your situation, but it's not going to be innocent spouse because it wasn't your spouse's income. So let's start and talk about what the commissioner said about the filing season beginning to start mid-February this year. So the source here was an article by Benjamin Valdez that was entitled, Long Predicts Later Start to Filing Season. That was published in Tax Notes Today Federal on July the 29th. The basic announcement was that IRS Commissioner Billy Long was giving a talk to the National Association of Enrolled Agents Tax Summit on July 28th, and he stated the upcoming tax filing season is expected to start later than usual. In fact, he indicated the IRS is anticipating right now beginning to be able to accept some returns around President's Day, which this year would be February 17th. So we're looking at that as our delayed start. This probably won't be a surprise to most of you, given the One Big Beautiful Bill Act and the amount of reprogramming that will have to be done in IRS systems to accept returns for that. But it's also more a little disappointing because, that's kind of a problem. We get delayed. So obviously, some of the implications, we know we're going to have a compressed filing season, right? Especially for clients that don't really bring their stuff in until you're ready to file. Well, there's no rush. You can't file it yet. So, why should I worry about bringing stuff in? Yeah, that's going to be fun. It may necessitate some issues internally with your firm. We're talking about internal workflows, how we're doing stuff, and also client communications. You need to manage expectations, right? And try to ensure timely filing, and also indicate why, yes, we can't file the return yet, but may still be very helpful for us to get it together, because while we can't file it, there's a very good chance we'll be able to effectively finish it before we can do the electronic filing submission. So, and again, there's 24 hours in a day, and so every day we lose, assuming you sleep 8 of those, and you're going to actually work full out for the rest, I mean, that would be, you're still losing 16 hours a day, and you're not going to replace that time unless returns go on extension, which we know gets with some clients into a total freak out at that point. Like, if they go on extension, they will be thrown in jail. So we're going to have that discussion. There'll be bottlenecks The compressed filing window would increase pressure on both those of us in practice and the IRS to handle this season because things are going to be more compressed when they start moving. As we said, we need a realistic timeline to our clients. Got to set realistic expectations for preparation. If we lose days, if days are gone, you don't bring it in because you can't submit it yet. We're just losing full days. And I can only do as many returns, as I can fit in the available hours. And, when you keep knocking off days from that because, well, you can't file it yet, you can't file it yet, can't file it yet, you're going to end up with, well, somebody's got to go on extension because we simply don't have time to get to all of these returns when we've lost what could effectively be nearly a full month, depending upon the nature of your client base. And traditionally we would hopefully get into, filing in mid-January. So that could be, as we said, a loss of effectively 30 plus days could be lost. And that's assuming the IRS hits the February 17th date, which, commissioners in a case like this have a tendency to overpromise and underdeliver. So don't be surprised if we go beyond that date as we get there. And also, like we said, for clients, encourage the clients to gather their stuff as early as possible. So basically we can have returns stacked up and ready to go as soon as we get the green light from the service. That's going to be key for the coming year. Also, make sure you communicate with your tax software vendor. Because of the OBBBA, we expect a more challenging tax season. We know a lot of states are going to make decisions on what they are going to conform to during tax season. So I'll have a whole bunch of other updates on that. It's going to be a challenging season at best. Delayed start is not wholly to blame for that, but it is partially going to cause some issues. We got to prepare clients for more extensions, right? If you're going to delay bringing your stuff in because the return can't be filed yet, then your chance of going on extension just went way up. So if you want it to be filed once we can file it and before the regular due date, then yeah, you will need to bring stuff in likely before we are able to file the return. Otherwise, we just get this massive returns coming in right around, here in late February. And, at that point, you've got what, a month, a little bit more than a month. And we know those last 2 weeks, the April part of it is scrambling mainly to get extensions calculated, get other things done. So yeah, we've got 1 month to get all of this done and somebody's got to go on extension. Clients just have to understand that's the way it's going to work this year. If you delay, you're probably going on extension. Keep it that way. Again, now we know, and one of the reasons why some people do this, especially people that expect to get large refunds, well, yes, it's going to affect their liquidity, right? Because they're not going to get the refund until they can file. Also, it can cause some financial planning, and that's both for individuals and businesses that expect refunds. It can foul up, what they're planning to do, their cash flow planning. We probably need to warn them early right now that, I know you like that big refund, but maybe you want to consider adjusting your estimates or adjusting your withholding to reduce the size of that refund because it may take a while to get it. Even when the IRS starts accepting returns, let's say around February 17th, it's highly likely that a number of forms will not be able to be electronically filed at that time. And if that's the case, we can't file the returns electronically at that time. We're just going to have to keep sitting on it. So, clients have no guarantee that February 17th will be able to file the returns. So they need to understand maybe this is not the greatest year, to continue to get those refunds that are, 100% of the tax due effectively. You basically double paid. This would be a good year not to do that, right? We also talk about the other effects, minor effects, effects to various households based on their income. How much IRS capacity, they have a capacity limitation of processing returns and do that. And this is going to stretch that because, again, the number of employees at the IRS is down dramatically. So like it or not, whatever you may think about the funding at the IRS and whether they had too many employees, the reality is that I don't believe it's somehow magically going to suddenly get way more productive, given what's going on right now, especially because a lot of those who have left are longtime experienced individuals. So you got brand new staff, especially, or inexperienced staff trying to fill roles, right? And now this is not out of historical precedent. We should make that very clear. Whenever there is a major law change, and we could say the OBBBA is a major change, we've often had delayed starts of the year. That's not terribly unusual. Now, what's a little more unusual is, though, the OBBA actually got passed relatively early, right? July 4th. This is not like the Tax Cuts and Jobs Act that got passed in late December, which really fouls up the time. So there was some hope, at least, assuming the IRS had the personnel to actually get this done, that maybe it wouldn't have been so bad this time. But certainly February 17th sounds like it's going to be about as bad as TCJA to get that involved as we get into that. Right. And also, there's going to be a lot of issues that will come with the states, tax software providers, etc., coordination, all these issues. Because remember, the IRS has to release forms for electronic processing. Then your tax software vendor generally has to get everything approved. And that's when you finally can start filing. So, your clients also need to understand that merely the IRS's ability to take something right now may not matter until our software vendor can get their systems updated and get approvals for electronic filing. So essentially, remember, the IRS is targeting a start somewhere around President's Day, February 17th, for the upcoming filing season. This is giving advance notice. You should consider communicating with clients about the fact that we expect next year the refunds to come out later, right? We don't expect, if you're getting a refund, obviously OTAX, who cares, is kind of that, which is fine. But if you're getting a refund, you're expecting to get that money up front early in tax season, yeah, you better start rethinking that. And as I said, maybe change your withholdings to not give the government extra money that they're going to hold until they get around to being able to finally accept your return. So, get your planning together to do this. Pay attention for any further IRS announcements updating these dates. We may see them move we might see them moved up, but I think far more likely is we're going to find announcements coming eventually that may move this date back, right? And again, the statement was reported in Tax Notes Today Federal from Tax Analyst. That is a for-pay publication. So just be aware, if you want to go read the article, you need to basically have, paid them for that bit. Okay, next up, let's talk about the case of what if you get lawsuit settlement proceeds? What's the tax involved in this, and how does it run? Okay. This case is Menemeyer versus Commissioner. This is Adrienne Menemeyer, filed the case. This is Tax Court Memorandum Decision 2025-80. Now, what we're going to look at here is the taxability of settlement proceeds, the deductibility of business expenses, or the real bad news about not having documentation, and the imposition of penalties for failure to timely file a return. So clearly, some of the key problems here is record keeping is really important, and you need clear documentation to substantiate your claims, as well as the fact that probably your settlement proceeds are probably fully taxable. You need to kind of understand that. So let's talk about this. So Adrienne was a former PNC Investments LLC employee. Now, she was terminated from her position on December 12th of 2013. That was followed by PNC filing a complaint, securities complaint, U5, alleging she was dishonesty. And that, of course, really made it difficult for her to find future employment in the securities industry, in the industry we are for investment, financial planning, investment type industry. So she eventually took this up to FINRA arbitration. It was initiated on December 3rd of 2015, just under 2 years after her termination. And she went after PNC for defamation, wrongful termination, unfair competition, tortious interference, and expungement. But the claims did not include any health concerns beyond emotional and psychological harm. And that's going to be really important for the tax status of these. Now, the arbitration award she got was $300,000 in compensatory damages, $1.5 million in punitive, and they were explicitly based on defamatory nature of the information, right, in that U5. Now, PNC and her then, they, basically they were threatening to, go ahead and try to appeal this. So she and PNC negotiated a settlement. So PNC agreed to pay her $1,510,000. And of that, $997,466 of that went to the taxpayer, Ms. Menemeyer, and $512,534 went to her attorneys, right? She signed a general release for employment termination and FINRA claims. There was no mention in her general release of health concerns or physical injuries. Now, the IRS audited her return, and they issued for the 2018 return, and they issued a notice of deficiency on March 15, 2023, of $588,906 and $164,389 addition to tax. The primary issues before the court regarding this IRS saying you owe us money related to the statute of limitations for assessment, to have the IRS assess the tax in time, also related to the taxability of her settlement proceeds. We're talking about, the potential exclusion under 104, and let's get a little bit ahead of ourselves here and say it will be the reason why she didn't meet it. We're going to talk about deductibility of various purported business expenses. That will include the expenses she incurred to essentially get her settlement, to have this litigation, what she paid her attorneys, but also expenses in another side business she started operating, right? Because again, she really couldn't get reemployed in the industry she was in. And finally, liability for a failure to file penalty. We'll talk about all of those. Now we go. So let's talk about taxability of settlement proceeds. Under the Internal Revenue Code, Section 61A, which is the place we always start in the IRC, gross income includes all income from whatever source, and that would include settlement agreement proceeds. So basically, things are income unless we find a way to kick them out, either to make them find us something in the code tells us it's non-taxable, or find something that allows us to claim a deduction against that income. So in this case, Section 104A2, which is what she's going to try to argue, it excludes amounts received on account of personal physical injuries or physical illness, but explicitly excludes emotional distress, not defense, but distress. Now, in order to use that, you need to show a direct causal link to physical injury or sickness that led to, the damages you're seeking to exclude. So what the court did to analyze this, they're first going to examine the express terms of the agreement. And if that's ambiguous about what it covers, then they're going to look to evidence of the intent of the payor. Was the payor paying for this physical injury, etc., or not? Generally, the uncorroborated statements by the recipient of the funds aren't going to work here. You're going to need some evidence of the intent of the payor. Now, the settlement agreement itself, though, was unambiguous. It broadly released claims related to employment FINRA, but never mentioned physical injuries. Let's say that's a bad fact as we get started. Now, her testimony about PNC's health concern was given little weight. She had no independent support that PNC was worried about having to pay damages on the health claim if they didn't come to some sort of agreement on this. There was no real evidence she ever raised a health claim in any of the documents she filed. She or her attorney had filed. So that's one of the problems you're going to run into. The arbitration claims focused on defamation and economic impact of job loss, not health. Remember, she brought this under a FINRA arbitration clause. So these damages relate to what was involved in that case. The court concluded that she had to include the full amount of the settlement in gross income, right? It was not received on account of personal physical injuries or physical sickness, but for defamation and economic damages, neither of which are excludable under the rule. What about, though, she paid like over a third of what she got to her attorney. Can she get a deduction for that? Well, we get back to the origin of the claim theory. Well, this will be pretty easy. This came from the claim she had related to her employment. Now, a few years ago, we had rulings that told us that would be bad because that'd be an employee business expense. And today it'd be really bad, because those aren't deductible. and will not be in the future after after OBBBA passed. But Section 62A20 was added to the code. It permits an above-the-line used in computing AGI deduction for attorneys' fees in unlawful discrimination actions. Now, you might think right away, yeah, but I don't see any allegation of discrimination in this case. She didn't say, she was discriminated against first, due to sexual harassment, things like that. She wasn't arguing that she had been dismissed based on, a racial discrimination issue, religious issue. She wasn't arguing it, so it's not discrimination, right? Well, remember, we have definitions, right? And a key definition we have here is under 62E, unlawful discrimination is defined to broadly include any aspect of employment relationship, including claims for wages, compensation, or benefits, or prohibiting the discharge of an employee. And so what happens here is suddenly that's a big thing. So the court ruled that her claims related to her employment and lost wages. Because of that, this was a discrimination payment to the attorney under 62A20 due to the fact that 62E has a specific definition of what's considered discrimination case. And this case fell within it. So she is allowed to get the deduction for her, for the legal fees related to her employment and lost wages claim. And, and basically the parties were instructed to consider that deduction when computing the tax due. So she owes tax on the award, but she is going to get a deduction for the legal fees. Okay, so keep that in mind. I mean, I think a lot of people remember the rule was it's a discrimination case, and you would immediately conclude it's not. Please remember, definitions exist in the law. You want to make doubly sure that there isn't. If you're just going to think, it means a general idea of what I think discrimination is, you better double check and see if the law has a different definition. In this case, it did. So what might not arguably seem to be a discrimination case turns out for federal income tax purposes is. It'll work to her advantage. Now, she also ran a Schedule C business called Olive Tree Enterprises. And she claimed various deductions here. The key I was going to worry about today are cost of sales and basically expenses related to her car, both depreciation on the car, or in this case, actually a Suburban, so let's say the SUV, as well as expenses for, other car-related expenses, travel in that case. So one problem that Ms. Menemeyer had was she really, really didn't have good records at all. And so one of the key problems we had for the cost of goods sold is her boyfriend, apparently, who was a CPA, had computed up an expected cost of goods sold, but really didn't have any records to back it up. There were very, very few records. Now, the IRS had agreed to allow a certain amount during the exam, but of course, she was trying to claim the full amount claimed on the return. The problem was that the ledger they had was unreliable because it mismatched all the invoices. None of the backup data agreed with what was there. So the court essentially said, we're going to let you, obviously the IRS said they're allowing X. We're not going to change that because they're not saying we should reduce it, but we're not going to give you any more than they allowed on exam. The other problem related to her car. So she had a Suburban. She's looking for the expenses, the essentially deductions for depreciation related to her SUV, the Suburban, right? Now that is listed property under 274D. Right? So it still falls within that category, even if it's not a quote unquote luxury automobile because over the 6,000 pound rule. So don't confuse those two. So while we don't have a limit on bonus depreciation, we do have, though, the standard rules for documentation for any listed property, which the Suburban is. Now, the problem was, you might guess she has no records of cost of goods sold. What do you think the chances are she has good records on her car? Yeah, pretty close to none. And it turns out that was exactly the problem. She didn't have the required substantiation. There were no logs or any other contemporaneous records from which you could determine her business use of that item. Even with credible testimony on business purpose, you can't use that here, right? The law is clear, no deductions allowed. And so, yet again, I got to remind people of this. They don't say, oh, they'll give you something. No, the court fully agrees that she drove this truck for that business. But it didn't matter because the law says no deduction. Zero is zero. Clients seem to think, oh, I'll get something, right? Just have bad records. It's like, no, the answer can very well be zero unless you have contemporaneous records to document the business use. And the same problem then happened for the other car and truck expenses. In addition to her depreciation, the same rules apply. Listed property because it means of transportation. And some of you may say, hey, Cohen rules, right? Cohen doesn't work. 274D is what I refer to as the anti-Cohen provision, enacted by Congress specifically to, essentially for the type of expenses that George claimed, George M. Cohen, they were basically aiming at those on 274D and saying no records, no deduction. So essentially, doesn't work, lack of records. She lost all of those deductions. That's just how it works. Now, there was a bit of a claim. She was arguing that they're outside the statute. But the problem was that the court found that she had signed Form 872. She had extended the period for assessment to October 15th of 2023. And a notice of deficiency was issued well in front of that date, on March 15th of 23. So the limitation period had not expired when the notice of deficiency was issued. The next problem she had was that, according to the IRS, she had not timely filed her return for the year in question. Now, she filed on October 15th, 2019, right? Now, technically, she said so, the 2018 return was originally due on April 15th. Now, it's not an accident. Obviously, she filed on October 15th. That meant she thought she was on extension, which she did. Now, she claimed that there was a 4868 mailed. And in fact, it was supposed to be prepared by her CPA boyfriend, who supposedly, had that file. Now, while he claimed he'd prepared and filed it, he admitted he couldn't remember if he'd mailed it or if a member of his staff had mailed it. And he did admit he couldn't testify he had seen it actually be mailed. And I don't know that any of that would have mattered anyway, but, that was it. The court made it very clear. The way you could have solved this problem was use certified mail, right? And you can't blame your CPA boyfriend. Well, you can. I'm sure she did, and justifiably for some of this, I'm sure. But for purpose of analysis penalty, you can't do that, right? At least the IRS is going to collect it from you. Then you might see if you could get it from him. But that's a different problem. Okay, so basically what we're going to get here is that, because the theory is she knew on April 15th the return was due. She knew it wasn't going to be ready. She had to make sure that the extension got filed. You cannot delegate that, right? In essence. Now, that's bad news for us that are CPAs or EAs or attorneys or anybody doing any of these filings that have a due date. If you do them for the client, you got to remember that the client cannot claim that they have reasonable cause merely because, they thought you'd filed it. That's not, the Supreme Court decided that years ago. That's not reasonable cause for late filing. So because of that, they said even if it had been mailed, because, the regs allow you to get the proof of mailing via certified mail, that you're assuming the risk of non-delivery if you don't use registered or certified mail or one of the private delivery service options. So she failed to carry her burden of proof, and she's liable for basically failure to file penalty, which of course is going to drive this up a bit because that's going to mean she was, a bit late, shall we say, in filing the return. Should have been done in April, ended up being done well after April. So yeah, she's going to get hit with the 4.5% that eventually gets to effectively, maxes out at 25 on the failure to file. So she's going to have a 25% failure to file. And that weird reason is 4.5 is that technically the failure to pay runs on top of, runs in addition, but we can't have more than 5, so we reduce failure to file. Yeah, it's a weird calculation, but essentially she's still going to be nailed for that. There's an automatic increase of at least 25% along with her failure to pay numbers that will go on top of that. So we have a little problem there, shall we say, for her. As we went into that. Accuracy related penalty, the IRS did concede. They didn't try to push that one forward. So 20% penalty there. They didn't go after that for her. That they felt that she had, she had reasonably, the CPA knew about everything with her. He had advised her she didn't need to pay tax on this. Her attorney apparently had also indicated she didn't need to pay tax on this. Right. So, it's like, nope, they conceded that, yeah, they weren't going to carry that. So the tax court sustained the commissioner's deficiency in addition to tax determinations, aside from the amounts related to the question of, the attorney's fees. That was there. Substantiation was a huge problem for her. Remember, 274D is utterly unforgiving when it applies. Now, auto is one of the big things it applies to. It applies to some meals now. It used to apply to entertainment. We don't get that at all anymore, so that's not really a problem, right? You also just have to have adequate records in general. Her cost of goods sold were not subject to the 274D requirements, but you still have the general requirement under 6001 to have adequate records. And while Cohen could help you there, the problem is you've got to show that there's a reasonable basis for estimating. And aside from what the IRS conceded, the court didn't find any basis for estimating reasonably what you should have incurred. So remember that. Cohen does not work for the cars. And even where Cohen works, you still got to have a reasonable basis for concluding how much to be allowed. Basically, settlement characterization, the taxability hinges on the on account of nature underlying the claims, not the taxpayer's belief or unproven payer motives. You got to have evidence of why they were paying it, right? And absent explicit language or compelling evidence of physical injury, the proceeds are likely to be fully taxable. You got to start that with the client and also remind them, didn't your attorney say that he doesn't give tax advice? Because I've had many times said, oh, I don't think it's taxable. It's like, I don't think it's taxable. It's telling you he's not telling you, right? And the problem is, yeah, it probably is. The attorney's fees, we got that in the employment relationships. Locked wages and discrimination qualify for above the line. Remember, this is, the issue that got there because hers was considered discrimination. So check the definitions carefully there. If you have somebody get paid by an employer, for dismissal, make sure you double check, whether or not for any legal fees incurred, whether this will be qualified as a discrimination payment to the attorney, for discrimination damages. Remember, for timely filing, the burden of proving extension was timely filed rests on the taxpayer, not any tax advisor they're using. And I said that's really a problem for us, mainly because while that's very true for the federal government collecting the penalty, that's not true in terms of when the client sues you in, let's say local court, because yeah, a local court is probably going to find that, they had a right to rely on you and you caused them to incur these big costs. Therefore, you're liable for them, right? So that's it. So practice advice, make sure clients understand the record keeping rules. That is something you should be telling clients. You have to do this, right? I'm going to ask you whether you have it and you need to do it. And if we get an exam, you better come in here with that stuff. And, and realize that if you think you're going to sit down when you get the exam notice and sit down with a blank Excel sheet and reconstruct records, I can tell you that in virtually there are a huge number of cases where the court has figured that one out and disallowed the whole thing. Make sure you do those and extension filing procedures in your firm. Really important to make sure you are carefully checking, especially with electronic filing these days. Even if in the old days you didn't take responsibility for, let's say, filing the extensions, the clients who are going on extension had to make sure that it happened. These days, almost certainly you're taking control of that. And that means make sure, because remember, there is no out for the client because my CPA forgot to mail it in. That's not going to work. Next up, we're going to have an AMT exception here, and I'll go through this. Probably doesn't apply to many people here, but it is going to be a major change if you're involved with the corporate alternative minimum tax. So I'll kind of skim over this, But these slides are really important, and the materials that you can download from our Current Federal Tax Settlements website, the article on this, really helpful, as well as, guys, go grab this ruling. If you're having to deal with this, grab it. If you've got a partnership investment in a corporation subject to the AMT, which generally is going to be very large corporations, but you have to keep this up. Keep in mind of this. Now, the corporate AMT was this version of it was introduced by the Inflation Reduction Act of 2022. It's IRC Section 55, and it applies to Apple corporations based on adjusted financial statement income, AFSI. So this is a C corp problem, right? There's a lot of burdens and challenges concerning partnership investments, and figuring out how that affects your financial statement income, AFSI, right? So the notice was provide interim guidance to simplify this application because they are withdrawing partially a portion of the proposed regulations on the corporate alternative minimum tax that was going to apply to partnerships after a lot of complaints from those that would have had to deal with that, right? So now you can rely on this interim guidance for taxable years beginning before any proposed regulations are published. So obviously, current year, the year you got now would, a year maybe a return you're getting ready to file for 24, all of those things, you could use this for that. Now, who's a capital corporation? It's going to be a corporation. And so it's not an S corp, not a registered investment company, mutual fund, not a real estate investment trust or REIT. It's meaning an average, relatively high average annual adjusted financial statement income test. Now, adjusted financial statement income from partnerships is defined under IRC Section 56A, C2D, basically I. It generally includes only the partner's distributed share of the partnership's AFSI, Apple Financial Statement Income, unless otherwise provided for by the Secretary. This is going to give us some otherwise provided for options. The Secretary has broad authority under Section 56 Cap AC 15 and 56A E to issue guidance and to prevent omissions or duplications. Now, previously, you might have heard of Notice 2023-7, which provided prior interim guidance on certain corporate alternative minimum tax issues, including partnerships, contributions, and distributions. This is going to a large extent supersede that ruling, okay, at least regard to partnerships. Under the proposed regs, it took what was called a bottoms-up approach, and this was issued in September of last year. So it required your corporate alternative minimum tax entity partners to compute distributed share partnerships AFSI by disregarding financial statement income from investments and including distributive share amounts in there, right? So we're going to go through and reach through and do a flow through. Contributions and distributions, proposed regulation 1.56A20, generally mandating inclusion of income, expense, gain, or loss from transaction in the AFSI. That proposed regs would have allowed deferred recognition approach of financial income to align with subchapter K principles. So that would be the deferred sales approach for contributed property. Would be fine, where we don't recognize it until it actually gets sold. And crucially, the treatment of partnership liabilities for AFSI were based on AFS treatment, not 752. So liabilities are going to be allocated differently for this purpose. That complicates matters as well. A number of comments highlighted the complexity and the burden and requested alternative methods. 2025-28, this notice addresses those concerns. So a couple of things. First thing is there's going to be a top-down election. A corporate alternative minimum tax entity's partners adjusted financial income is generally 80% of the top-down amount plus amounts from sales or exchanges and specific foreign stock adjustments. It bypasses AFSI adjustments. It avoids other Section 56A and proposed regulations adjustments. And the top-down amount is financial income attributable to the partnership investment, including financial income from property contributions and distributions, without applying Section 721, 731, Notice 2023-7, or proposed reg Section 156 Cap A20. Eligibility, any CAMT entity partner that's not a partnership, right, for one or more direct investments. So if you're investing in a partnership, the partnership can't make this election, but the actual direct holder of an interest in a partnership, who's a corporation that's covered by AMT, can do this, right? So it simplifies this determination for the partner. There's also the limited taxable income election, a different way. So in this case, a corporate AMT entity's partner's AFI equals its taxable income amount for regular tax purposes, plus sales or exchanges and foreign stock investments. So we're going to go to the taxable income limitation. Taxable income amount is the partner's distributor's share of income, gain, loss deduction from the partnership under tax law purposes, right? Applying all regular tax rules, 704C, D, etc. For contributions and distributions, we include all income, gain, loss deduction from contributions distributed as computed for regular tax purposes. Eligible, a CMA, it has to be a corporate AMT partner, right? Entity partner, not a partnership. Again, it must be a direct partner. If the test group of the group they're associated, their corporate group, does not own more than 20% of the partnership's capital or profits interest, and the fair market value of the partnership investments held by the test group is $200 million or less. The idea being you may not have enough influence to really get all the data out of there except taxable income. So it allows reliance on the regular tax principles, which they're going to have to give you. So that's an option, potentially. Also, you can use a reasonable method to determine the partner's distributed shares. You can use any reasonable method to determine a corporate AMT entity's partner's distributed share of modified, basically financial statement income. That method must be consistently applied to all corporate AMT entity partners of the partnership. It must align with Section 56A purposes and not result in improper allocation or the avoidance of CMT liability by allocating things away from the corporate partners. Reasonable methods, it could be their share of 704B income or loss, or provisions in the partnership agreement for allocating next 704B income or loss items, right? If it's applying proposed Section 156A-20, you have to use the same method for deferred distribution gain or loss. Also, reporting required modifications. This proposed Section 56A-5H and I. A corporate AMT entity can request information from a partnership up to 60 days before the partnership's federal returns due date with extensions. If that partnership fails to furnish the information, the corporate AMT entity may base its estimates on its own books and records without needing to continue best efforts to get better numbers. Right? Upper tier partnerships will have extended deadline for requesting from lower tier partnerships. And if a partnership uses a reasonable method for distributed shares, it must report each corporate AMT entity's partner's distributed share of the modified financial statement income. Okay. Finally, the modified Regs 20 election method. It applies proposed Section 156 Cap A-20 with modifications. Liabilities. Section 752, 1.704, Reg 1.704, 707-4, get that right. Reg 1.707-5 and 1.707-6, the regular liability allocation rules will apply to determine 721A or 721C. If 721A or 721C, get that out right, apply to property with liabilities. This is a major change from proposed regs ability that we can only use AFS, allocation of liabilities. Recovery periods will be a 15-year recovery period for Section 168 property, qualified wireless spectrum, or property subject to AFS depreciation and amortization. For property not subject to AFS depreciation, no recovery period, gain loss included generally only upon disposition, and modifications to acceleration events for gain or loss are found in here. Generally, it aligns your CMAT treatment of liabilities more closely with regular tax principles. Makes it simpler. Finally, there is the full subchapter K method, which is elected for the partnership. This does require the written consent of all corporate AMT entity partners, including those with top-down or taxable income elections. Affect the principles of subchapter K, 704C, 732, 734, 737 apply to determine partner distributed shares from contributions distributions using CMAT inputs, right? The partnership must adopt the same relevant methods and elections for CAMT as for regular tax. In essence, you got to, if you're using remedial allocation for regular tax, got to use that here. Any special basis adjustments must be handled in the same manner. It allows for more comprehensive alignment of CMAT with existing regular partnership tax rules. For financial statement income attributable to certain non-realization transactions, partners can disregard financial statement income from consolidation, remeasurement, deconsolidation, dilutions, or change in ownership of another partner, to the extent these are non-realization events for regular tax purposes. The exclusion does not apply to financial statement income from changes in fair value of a partnership investment. Appropriate adjustments to corporate AMT attributes and CMT base, such as corporate AMT basis, must be made to ensure proper, AFSI computation and prevent permanent elimination. The benefit is it prevents unintended corporate AMT complications from transactions that are not realization events for tax purposes. Finally, we're going to talk about the reliance and applicability. Taxpayers can use the guidance in this notice. If you have to deal with this, grab the notice. This is just a quick summary. You can use that for taxpayers beginning before the forthcoming proposed regulations are published. This includes amending returns or AARs that you file. So you can go back and fix something, right? For contributions, distributions, and tax years ending on or before September 13th, 2024, you can rely on this notice, Notice 2023-7, or the corporate AMT proposed regs. You have your choice. So any of those will work. Obviously, that means that August year ends generally will be the last ones that can use this, but they'll have the choice using any one of the three. Beginning with September 30 year ends, you have one of those for your partnership. That's going to have to use, in essence, they won't be able to use those 2023-7. They will have to, go ahead and use this notice if they want to have something they can rely upon. Reliance on the interim guidance will not violate consistency requirements of the proposed regulations for that year. And if alternative taxpayers may rely on the corporate AMT proposed regulations in their entirety without these modifications, if consistency is maintained across the test group. So you already set up to use proposed regs. That's what you've been doing. You don't want to change it. You're allowed to just keep doing that. So again, this offers relief. Make sure you note it if you think you're going to need that relief. Let's go up next with a corporate merger and the same taxpayer rule for interest netting. In this case, we're talking about two corporations you probably heard of that merged a number of years ago. We're talking about Bank of America Corporation, which is the taxpayer in this case. You may remember that back in the whole, Lehman Brothers crash scenario, et cetera, that eventually Bank of America merged, basically absorbed Merrill Lynch. So we had that eventually come out of all those situations. Now, this is from the Fourth Circuit Court of Appeals, case number 23-2319, decision issued on July the 29th. Now, this is an interpretation of the same taxpayer requirement. Under Internal Revenue Code section 6221D for interest netting, in this case, following a corporate merger. And it looks at whether a surviving corporation can net pre-merger tax underpayments of one entity, now part of the group, against pre-merger overpayments of a merged entity, the two that weren't associated at the time these underpayments or overpayments took place. And in this case, the Fourth Circuit affirmed the district court's decision in favor of the government that can't do that. Let's talk about the case. The parties here were Bank of America Corporation, the surviving entity, and Merrill Lynch. Their merger was finalized in 2013. Now, Bank of America sought to recover, this is not a minor netting adjustment we have here, $163,429,627 in underpayment interest paid and overpayment interest owed. Okay, back to them. So they're asking for $160 million. This is not a minor adjustment, shall we say. Now, the bank said following the merger, Bank of America became the same taxpayer as Merrill Lynch. For these purposes, that's their argument, meaning with respect to or concerning was the word they were concentrating on. Okay, so they're saying, hey, we're all one big happy family now. So we want to be able to net, even though these overpayments, underpayments that rose back in the year where Merrill Lynch and Bank of America had nothing to do with each other, we still think that we should be allowed to net them. Now, they argued for this based on a couple of positions. First, they said that 6621D should be interpreted consistently with section 6402A, which is balance netting, not interest netting, but netting overpayments and underpayments of the same taxpayer under 6402A. And they also claim that Delaware merger law, which governed this merger, retrospectively treats the surviving and merged companies as the same federal tax purposes. And that means that should bind the IRS. They have to follow the state law. Now, two scenarios were involved in this. B of A had underpaid taxes in 2005, and Merrill Lynch had overpaid. They had an overlapping interest accrual. As well, we have the same B of A underpayment for 2005. We have a Merrill Lynch overpayment from 1999 that also had an overlapping period. So again, the merger was on October 1st, 2013. That was years after these particular underpayments and overpayments took place. So the question is, can we net? And we are talking about over $160 million. Is the answer to this in the reduction in interest, effectively net interest paid? Now, under Section 6621D of the Internal Revenue Code, it applies when interest is payable on equivalent underpayments and overpayments by the same taxpayer. That last phrase is there. Now, the court said the phrase by the same taxpayer modifies equivalent underpayments and overpayments, but not the interest. Okay. The question is, which one does that say? Is it interest by the same taxpayer or underpayments and overpayments by the same taxpayer? Now, the court said the last antecedent rule of construction. Remember, we've talked about those rule of construction regarding when you analyze a statute. This is another one of those such rules. They're saying that, you basically, you're looking for what's the closest one, right? In regards, so it says using that rule, it would imply the underpayments and overpayments themselves must have been made by the same taxpayer, rather than interest now being owed by a taxpayer in that regard. They also said the meaning of by, which again, we get into weird things about what word means. The most natural interpretation of by in this context is through the means or instrumentality of, meaning the same taxpayer must have made the payments involved. Whether they overpaid or underpaid, has to be the same taxpayer that made these payments, not the same taxpayer paying the interest. Got that? Okay. Now, the court rejected this respect to or concerning, which would have put the focus on the interest, finding it less natural and effectively rewriting the statute to focus on current liability rather than the original payment maker, which is how they say is the proper way to read the statute. And they cited precedent in the area. They're about the East Energy Court versus United States. That held a statute required the taxpayer be the same when the overpayments and underpayments were made. And also Wells Fargo and Company versus U.S., another bank situation with a merger. A merged corporation could not net pre-merger interest for payments made by different corporations because it's the identity corporation at the time of the payment that matters. Okay. So in essence, we're looking at whether at the time of payment were Wells Fargo and Bank of America the same corporation, and they weren't. It's only going to be true for payments made after, after October 1st of 2013. Those would be the ones where they could become the same taxpayer. Now, the bank said, wait, but that's inconsistent with IRC Section 6402A. That allows the IRS to credit overpayment against any liability in respect of an internal revenue tax on the part of the person who made the overpayment. Now, the court found that these provisions have materially different language and purposes. They found that the balance netting 6402A that I just gave you, that allows netting when the person who made the overpayment has any liability, including a liability that was originally incurred by another merged corporation. The focus is on the liability. A merger might make the surviving entity a composite for balance netting purposes. Now, interest netting has a narrower scope. It requires overpayments under and overpayments by the same taxpayer during an overlapping interest accrual period. A post-merger composite status for that entity does not retroactively make distinct pre-merger's entity the same for interest netting. Okay. Also looked at the legislative history of 6621D. The provision was added in 1998 to allow interest netting even when the underpayments were no longer outstanding. However, the court found no indication Congress intended to treat companies that later merge as the same taxpayer for pre-merger payments, creating refund opportunities. Okay. Policy considerations the court considered. They said arguing netting could lead to abusive mergers that have no purpose other than retroactively create the same taxpayer for an interest netting claim. While B of A said that'd be ridiculous. Who'd go through all that? Court said this is $160 million. There's enough at stake to pay for a lot of legal fees, to take care of this. So you might actually have a merger where you just go try to find a company doing not much, but currently doing not much, but it could have the right offsetting periods. They're saying there could be abusive transactions designed under that, not terribly difficult. They're saying, yeah, we think that also argues against it. What about, though, Delaware state law, right? State law governs, right? Well, not in this case. State law generally applies when the federal law cannot basically directly address an issue, right? Bank argued Delaware merger law retrospectively treats entities as the same for federal tax purposes. Well, the court rejected that for two reasons. They said federal taxing power is not subject to state control unless explicitly made dependent on state law. And IRC section 6621D is clear on the same taxpayer requirement at the time the payments were made, and they were not. And they also disagree that Delaware law somehow magically makes those the same taxpayer. Delaware merger law means the surviving corporation absorbs identities and liabilities after the merger, not that the distinct corporations become the same taxpayer prior to the merger. So it disallowed that. So fundamentally, the Fourth Circuit affirmed that Bank of America and Merrill Lynch were not the same taxpayer when they made underpayments and overpayments at issue. They were distinct corporate entities at those times, the years before the 2013 merger. So Bank of America, the surviving entity, is ineligible for interest netting under 6621D for these pre-merger payments. Okay, for interest netting under 6621D, the identity of the taxpayer at the time that payment was made, right? The underpayment or overpayment was made is what's key, not their post-merger status or absorption of liabilities, right? Remember, so you got to remember that you cannot net, at least in the Fourth Circuit. You may want to challenge it in your own circuit. If you've been no decision there, that's a whole different discussion to have with counsel. But consider netting timings, underpayments, and overpayments relatively corporate restructuring when assessing interest netting opportunities. This ruling suggests in the Fourth Circuit, at least, they're going to strictly interpret same taxpayer as looking at what were they truly the same taxpayer at the date that the payment was made. Next up, we're going to talk about what's an educational organization for unrelated business income tax purposes. And the Mayo Clinic, who gets involved in these things all the time. We're talking about the Mayo in this case. This is Mayo Clinic versus United States. This decision comes from the 8th Circuit Court of Appeals, case number 232246, and it came down on July the 30th. Now, the key issue is definition of educational organization under Section 170B1, Cap A, 2II, and its implication on unrelated business income tax exemptions. So in this case, the taxpayer is the Mayo Clinic. You might have heard of them, right? A Minnesota nonprofit corporation that has 501c3 status. It is a not-for-profit organization. Now, Mayo was looking for a refund claim of $11,501,621 in unrelated business income tax assessed by the IRS for debt-financed property income. So not as big as B of A, but still definitely worth fighting over, right? Now, Mayo claimed an exception under Section 514C9A and C1 of that same subsection. And it provides an exception for debt incurred by a qualified organization acquiring or improving real property. Generally, debt-financed property generates UBIT, but there are exceptions. This is one. So the question becomes, is Mayo Clinic a qualified organization? And the definition of 501c3 educational organizations as described in Section 170B1AII, the qualified organization, it's organizations normally maintaining a regular faculty and curriculum and a regularly enrolled body of students. And Mayo Clinic does train doctors. It's arguably, one of its key reasons for being. Now, IRS said, wait, Mayo's acquisition indebtedness was not exempt because it did not meet the definition under 170B1 capital A double 2 qualified organization under the regulations that applied in this case. Those regulations are 1.170A-9C1. This regulation required the organization's primary function to be the presentation of formal instruction and non-educational activities be merely incidental under the reg. Now, in the first case of this, which came up in 2021, and where the 8th Circuit reversed the district court, in that case, the district court had invalidated the regulation's primary purpose and merely incidental requirement. But Mayo found, the 8th Circuit found that was a valid interpretation of the law and consistent with settled judicial interpretation of exclusively in 501c3. However, the Eighth Circuit agreed that that the specific requirement for primary function to be presentation of formal instruction was an unreasonable condition, and therefore they invalidated it to that regard. Okay. Now, the case was sent back for further proceedings because the record didn't definitively establish that Mayo's overall purpose was exclusively educational, right? So, and here from the case, there was a crucial item in that decision. It said the presence of a single non-educational purpose, if substantial in nature, will destroy the UBIT exemption regardless of the number or importance of truly educational purposes. That sounded bad because Mayo does do a few other things, right? We'll talk about that. We'll go for it. Now, on remand, the district court concluded primary in this context means substantial. Now, we're going to discover that 2 of the 3 judges on the panel were okay with that. One's uncomfortable with that way of defining it, right? It found Mayo had a substantial educational purpose and no substantial non-educational purposes due to its inextricably intertwined functions. Now, you're going to find out that the concurring judge had no problem with the fact that all the other functions were completely intertwined, but they didn't really think that merely being substantial would necessarily be enough to have it be the primary purpose. Now, the government had argued primary means principal or most important purpose. Okay. Now, the Eighth Circuit analysis, which affirmed the district court, they relied on a case from the Supreme Court, a Board of Governors versus Agnew, a 1947 case, 329 U.S. 441, where the Supreme Court interpreted primarily engaged to mean essentially or fundamentally, where an activity can be primary if it is substantial. They reasoned that this better aligns with the difficulty in isolating a single predominant activity for an academic medical center like Mayo, whose education, patient care, and research functions are inextricably intertwined. They also said that this is consistent with trade regulations. It aligns with the broad view of tax organization, education purposes, and trade regulations, which includes museums, zoos, and symphonies as educational organizations. Symphonies are considered entertainment as much as they are considered educational. So if you use this, if you said it was basically primarily, it had to be, essentially had to be totally involved, then those wouldn't qualify, but yet the IRS regs indicate they do. They also distinguished this from a case of Millott versus Riddell, a 1966 Supreme Court case, 383 U.S. 569. Millott defined primarily as a first importance for differentiating between 2 tax treatments or income versus capital gain. But Mayo involves an organization with multiple substantial charitable functions. So the district court, the basic Court of Appeals panel concluded district court did not err in interpreting primary as substantial. Even if principal were used, Mayo's patient care activities are not non-educational due to their careful integration with education. Now, the government said that Mayo's hospital network and patient care activities constitute a substantial non-educational purpose. Remember, they have one of those to be disqualified. Now, the Eighth Circuit distinguished this case, though, from the Supreme Court's Better Business Bureau case. In Better Business Bureau, the Supreme Court found substantial non-educational purposes. Promoting a profitable business community was a very substantial non-educational purpose. In Mayo 1, the court had clarified that overlap with other charitable categories is okay unless a substantial unrelated, and unrelated is the word they're going to emphasize here, non-educational purpose exists. Now, the district court found that patient care is certainly a substantial purpose, but it's not non-educational at Mayo. This is where you get to the intertwined, right? Evidence showed no substantial clinical practice function that did not further the goal of providing training and education. So a 501c3 organization with a hybrid function that furthers its main charitable purpose as well as education, right, or furthers a charitable purpose as well as education, could still qualify as educational. Therefore, borrowing for real estate wasn't going to be a problem and create UBIT income. They looked at Mayo's organizational structure, governance, and mission statements. They consistently reflect the principal role of education. The 1919 Deed of Gift established that the core purpose of the Mayo Foundation is promotion of medical, surgical, and scientific learning, skill, education, investigation. And the bylaw preamble provides earnings for better care of the sick, medical education for better trained doctors, research, and general welfare of the public are involved there. It's also their operation is consistent with this level of integration. They have extensive educational offerings. They have absolutely stellar accreditation, right? And high board certification rates for their students. The students are taught anywhere that there's patient care. That includes operating rooms, hallways of the facilities. The physicians at Mayo are expected to participate in education and obtain academic rank. And over 97% of the physicians currently at Mayo hold such a rank. Medical treatment and research always serve an educational purpose, even when increasing healthcare costs by incurring them. There's significant investment in schools, a high volume of complex cases. They fly in patients from Mongolia for $5 million a year to meet educational requirements. Education and research activities are operated at significant net financial loss, spending more than they're earning from patient care. And their expansion to Florida, Arizona, and the Mayo Clinic Health Systems, MCHS, improved the educational offerings by broadening the patient base. They are saying they weren't doing that to simply become a hospital, right, and provide patient care for charge. That wasn't their background. So they conclude that Mayo uniquely integrates education, research, and clinical practice across all of its operations, rendering patient care, while substantial, not non-educational. It's not in itself rather than a means of accomplishing a charitable goal, which gets us in with this. What does this mean for us? Well, judicial precedent, right? Conclusion, they said regulatory guidance that their decision was supported by living faith case. A single activity can have multiple purposes if it furthers exempt purposes. They distinguished this case from the Redland Surgical Services case, where there the not-for-profit had ceded control to the for-profit entities and was supported by Domain Farms. Commercial purpose directly benefited and furthered the exempt purpose. It's reinforced by a broad definition of educational in Treasury Reg 1.501C3-1D3I and a 1969 IRS letter ruling recognizing Mayo's integrated mission. So the final ruling was the judgment was affirmed. Mayo is an educational organization under 170B1AII. So essentially, what happened here was they rejected the government's arguments, but be careful. These facts are really important. I know there's going to be some charities try to run with this in a way that it won't work. Again, super tight integration. And you notice the court mentioned that those patient care functions were not being operated, with fees coming in excess of costs incurred. That might have made a big difference if they had. Statute does not mandate an organization qualify only under one category to get this exemption. Now, Judge Graz, who was concurring, he concurred in the judgment. So he said, yeah, Mayo shouldn't owe this UBIT. But he was not comfortable with equating primary with substantial, arguing that kind of structure defies plain English. I mean, substantial means a lot, but it doesn't mean primary. And he's like, that doesn't make sense. But he agreed even if the primary meant most important, that Mayo's principal purpose is education, so it would change the result. He's just uncomfortable with the holding that suggests that if you had a substantial purpose, that it could become your primary purpose. It's like, that doesn't really, merely being substantial doesn't really mean that it was your primary purpose. So I think he's got that. But implications for practice for nonprofit tax exempt organizations, academic medical centers, especially that operate like Mayo, which probably isn't a huge number, interwoven activities, even substantial commercial ones like patient care, can be exempt if they're integrated with and furthering the primary exempt purpose. In this case, education, which is the category we need to fill it. The distinction hinges on whether the ostensibly non-educational purposes serves as a means to, rather than in itself and apart from, the educational mission. We have another micro-captive arrangement that failed at court. These have been happening a lot recently. This is Cadu versus Commissioner, Tax Court Memorandum System 2025-81, July 31st, 2025. We're going to take about whether you can deduct expenses for what's purported insurance coverage through affiliated captive insurance companies, in this case, Risk and Asset Protection Services and RMC Property and Casualty Limited. In this case, the taxpayer, Curtis Cadu, was the sole shareholder of Surface Engineering and Alloy Company, Inc., an S corporation. Now, the IRS asserted this arrangement did not constitute actual insurance, disallowing deductions and imposing accuracy-related penalties. The taxpayers sought to deduct premiums under IRC Section 162, and they contested the penalties. So, what's the background of this? Surface Engineering, the S Corporation, had metal alloy production and sales and also maintained commercial insurance on its activities. Now, RMC Group, their involvement, they're the promoter in this case, right? Mr. Cadieux is referred to the RMC Group, right? A consortium promoting active insurance arrangements. Now, Mr. Rochelle, who is an actuary for RMC Group, conducted a study recommending annual premium funding of $1,195,680 for a Nevis-based captive. Nevis is location, came out of where, right? So they're going to go there. Now, how'd they form? Risk and Asset, a Nevis corporation formed on October 3rd, 2012, was incorporated. Mr. Cadieux was a sole shareholder and chairperson. He contributed $50,000 of capital to this, which would be a primary insurance company, right? So Risk and Asset issued primary layer policies, Surface Engineering, right? That includes excess business interruption insurance, collection risk insurance, and directors and officers liability insurance. Now, Surface Engineering also purchased excess layer coverage from RMC Property for exactly the same risk. Okay. Now, the premiums paid to RMC Property were identical to what was paid to Risk and Asset. One half for primary, Risk and Asset, and one half went to RMC Property. So we split everything up that way. Now, what happened, though, was the funds that went to RMC Property, the reinsurance arm, were transferred to Risk and Asset, less RMC Property's commission, which seems like the funds are just going round and round. Aside from paying the promoter, well, that's going to be a problem, as we'll discover. Now, that initial 50-50 split adjustment was changed unilaterally by RMC Group to a 40-60, right? Risk and Asset had 40%, RMC Property got 60, and then 30-70, again, sending more to RMC Property, right, the reinsurer, without any additional actuarial analysis being performed. It was specifically to get more claims to the excess layer. I think they became concerned that if the excess layer was never paying off, it would be real questions as to why in the world an excess layer insurance was even purchased. Now, over the time, Risk and Asset paid $260,310 in collection risk claims to Surface Engineering in 2016-2017. So there were claims under the policy. Now, far less than was being paid in premiums to these organizations, but, what do you know how it works? So the first question that the court looks at, as it did in the previous ones we've covered, is this insurance? Again, not defined by the courts, not defined, say, by the Code of Regulations, but the courts used 4 factors. Is there an insurance risk? Is that risk of loss shifted to the insurer? Does the insurer distribute its risk among different policyholders? And is the arrangement insurance in a commonly accepted sense? Now, the court's going to look in this case for risk distribution and commonly accepted notions of insurance in a micro-captive case. Now, the court found, sorry, you failed on distributing risk. A handful of direct policies, Surface Engineering, failed to achieve risk distributions on their own, right? It's all the same. There's lots of chances all going to be linked, right? It's not really distributing risk. It's all going to the same customer. Also said the near circular flow of funds, where Surface Engineering paid RMC Property, was transferred nearly all the funds back to Mr. Cadieux's wholly owned captive, Risk and Asset, meaning Mr. Cadieux really never lost control of his money. That suggests a non-arm's length transaction and insufficient capitalization. Arm's length contracts, we found that we didn't really have those. The premiums were 2.5 to 3.5 times more expensive than comparable commercial policies they could have obtained with effectively the same terms. That suggests the primary advantage was an increased deduction. They didn't care how much they paid. In fact, paying more was better, right? They just got an increased deduction. And so it's not arm's length negotiation. And Risk and Asset was very thinly capitalized. $500,000 plus $300,000 initial premiums is all that went in initially, right? And actually determined premiums, though, the court had substantial reservations about Mr. Ravel's purport. It was prepared quickly, did not have client documents, and then even if that had been okay, RMC Group unilaterally changed the premium splits to get claims to the excess layer, right? And there was no actuarial justification for doing so. And the premiums remained unchanged for 6 years without any revision. You've ever got an insurance policy that went for 6 years with no change? Yeah, that's not how things work in insurance. So they said, hey, risk distribution was not achieved. It was basically, in this case, the taxpayer, right? The basically surface engineering was essentially, which was an S corp, so it went back to Mr. Cadu. It was essentially just they were self-insuring 100%. They were just sitting on their own money, and we're just moving it around, making some journal entries, and hey, that's what we're doing. Okay. The court also found even if risk distribution was met, the organization, operation, and regulation, yeah, they found that those kind of rule against as well. Risk and asset had no employees, and Mr. Arnold's participation was minimal. Didn't look like anything was going on there. There was little due diligence on premium prices or reinsurance agreements. Nobody really checked for any of that stuff. They didn't worry about what prices would have been or whether reinsurance arrangements were out there. We were going through this thing. Over half of risk and assets investments in 2017 were a $6 million life insurance policy on Mr. Cadu to cover personal mortgages if he died. That's not considered an effective means of hedging risk, right? If all you're doing is collecting money and turning around and buying a life insurance, then yeah, that's probably not a way of hedging risk. That wasn't a hedge. That was simply, trying to cover buying life insurance policies on Mr. Cadu by running it through here so we can claim it was somehow business related. Now, and I also noticed that, as soon as the IRS audit notice was received, they stopped doing this. So, yeah, they kind of knew it was out there. And they said operations and investments weighed heavily against it being an insurance company in the commonly accepted sense. Now, for capitalization, it says it did meet Nevis's requirements for an insurance company, but it was, without question, thinly capitalized. That was deemed a neutral factor. It did not either favor showing that this was a valid insurance structure, nor did it prove it wasn't. It was just irrelevant. It's not going to be the thing to decide this. Were there valid and binding policies? There's mixed evidence. Some terms limited coverage, some lacked beneficiaries. The directors and officers' policies reimbursement only, unlike upfront commercial policies that are more normal. It weighted slightly against the petitioners. Reasonableness of premiums, they're not reasonable at all, right? Not reasonable, not arm's length. It was a high rate online, no premium reductions due to having no claims for years. If the tax benefits were disregarded, essentially the premiums were in the same economic position that they would have held by self-funding the liability as opposed to this. That weighed heavily against presenters. This is the problem. They were inflating, the court found they were inflating the premiums because that's how this had to work. You were mainly getting a deduction for what wasn't really insurance premiums, but calling them that and using a special micro-captive rules to get a deduction with no offsetting income. And they're saying that didn't go. Review of payments and claims. Claims were paid, but the process were perfunctory. The committee met infrequently. Mr. Cadu often acted as sole determinant without independent adjuster. That was a neutral idea. And the court said most factors weighed against the petitioners, and essentially the payments were not for insurance. Paying wildly in excess of the amount that you would have had to pay for true insurance from an unrelated third party is an automatic red flag in these occasions. And we were talking about they were paying wildly in excess. And it was pretty clear that they weren't really setting their premiums based on risk. They were setting their premiums based on how can we get a nice big tax deduction. How much cash can we afford to lose for a little while to, free up for a little while to get this big tax benefit? Didn't work. Now, I know, now the taxpayer tried to say, they claim that essentially the IRS had conceded elements of insurance in a prior district court case, Anchor versus United States. And they're implying, therefore, they were stopped from arguing different here. The court said, you misunderstand. The mere fact that a party in a suit did not contest an issue is very different from conceding the issue. Collateral estoppel and judicial estoppel do not apply because Mr. Cadu, risk and asset, and service engineering were not parties to Anchors and the issues were not fully litigated, so you don't have a chance. They also said we comply with Revenue Ruling 2289, the safe harbor. They said they achieved risk distribution by earning over 50% of premiums for unrelated entities through the RMC Group's reinsurance pool. The court said the facts were not substantially the same as those provided for in Revenue Ruling 2022 or 2002, I should say, 89. Property arrangement, basically property arrangement was not operated consistent with the standards applicable to an insurance arrangement between unrelated parties. Premiums were extraordinarily high, and basically the IRS expert calculated only 18% of future losses ever reached the excess or reinsurance layer. In essence, this was all put together not for insurance. Okay. And on accumulated earnings and profits, the IRS asserted the increased efficiency for 2017 was because Risk and Assets Section 953D election to read as U.S. Corp was invalid because it was an insurance company. The court did not find those IRS arguments. They said they were uncompelling. While not insurance for deductibility funds, they could serve other legitimate business purpose, such as contribution of capital. So outcome, that increased efficiency of 131,308 based on that was not sustained by the court. Okay. Now, what about penalties? The court found the IRS had adequate supervisory approval in 6751B1. They had achieved it in a timely fashion under the Eighth Circuit's measure. The court did not decide to rule on the 40% gross valuation misstatement penalty. It deferred the ruling for 2012 to 2015, pending further briefing on economic substance doctrine and relevance. So that's one where the IRS tried to say, well, this obviously was something lacking economic substance and grossly misstated, at that point. So valuations. So therefore, we should be able to get the extra 40% penalty. The court said, not so fast in this context. And there's another case moving on this right now on this issue, but we need to revisit that. Now, they claimed reasonable cause. They claimed they relied on RMC consultants and Mr. Revell. Now, Mr. Revell's work they found was limited, right? And RMC Group, they said, sorry, guys, that's the promoter. Advice from promoters is, according to the court, hardly disinterested or objective. His reliance was unjustified on them and lacked good faith. Relying on the promoter just doesn't work. They tried to argue they had substantial authority. They relied on Revenue Ruling 2289, which, of course, already ruled was distinguishable. And the initial case that started all these cases, the Avrahami case, a first impression obligation. They said, yeah, in Avrahami's case, it was a case of first impression. They found that they could say that, yeah, we could accept the authorities given because the court had never ruled on these applications. It's not happening here. We ruled that case's existence is part of your problem. You didn't consider it, right? Even though it existed, you never considered changing your operations or doing things. That defense fails. You didn't have substantial authority, right? In essence, once that case came down, the substantial authority disappeared. Argument. What about actually related penalty for 20%? They said, look, these understatements are substantial, over $5,000 or 10% of the tax due. They said it was way over the top of that. And since there was no reasonable cause and no substantial authority, the 20% actually penalty applied. We're still looking for the 40%. And as I recall, the interaction of the penalties, if the 40% were applied, then you wouldn't apply the 20% to the same deficiency. So we're really looking at an extra 20% on those ones they claim that were violating the economic substance background. Tax court emphasized the bar for genuine insurance risk distribution, commonly accepted notions, remains high for most micro-captive arrangements. They denied the premium non-deductibility, did not sustain the increased efficiency for, recharacteristic capital contributions remained plausible, and sustained a 20% actual penalty. So it's not good. They did get some things, but it overall was a bad deal, shall we say, at the end of the day. They didn't get the benefits they wanted. Next up, we have the case here in this case, involving a taxpayer who said, I didn't consent to filing a joint return, so I should automatically get instant spouse relief because you came back and you assessed tax against that joint return. Okay, this is the case of Fannie Wright versus Commissioner. It is case number 25-10563. It's from the 11th Circuit Court of Appeals from July 31st, 2025. This case was, and this, of course, is an appeal of a denial of innocent spouse relief where deficiency was traced solely to Fannie's income and the application of the doctrine of constitutional avoidance to a challenge regarding the removal power of tax court judges. Now, she sought relief from joint and several liability for 2013 to 2015 years. In this case, Manny and Willie Wright were married until Willie passed away in 2016. Now, they filed jointly in 2006, 2007, but then individually, right, separate, then resumed joint filings per the returns the IRS had for 2013, 2014, 2015. Now, Ms. Wright started receiving Social Security income in 2012 after a workplace accident. That Social Security income is includable in gross income and is subject to federal income tax under Section 61, 63, and 86. Right. The unreported income in 2013 and 2014. The joint returns reported Mr. Wright's wages but failed to report her Social Security income. So under Section 86, you had to include a chunk of her income. And that would have created additional tax liability if they did that. So the IRS issued joint notice of deficiency. In this time, there was a 2015 return that was filed, right? And this time including her Social Security income, that resulted in tax owed. Now, she claims she was unaware that Mr. Wright had filed joint returns for 2013, 2014, claiming she told him no, he hadn't. And she was advised she did not have to file. Okay. Well, now remember, she's seeking innocent spouse relief for 13, 14, and 15 under Section 6015. Now, initial denial on June 14th, 2017, and appeals denial in 2018 stated all of this debt is basically linked to Fannie, to you. Relief is not allowed on tax you owe on your own or jointly owned income. Now, Ms. Wright challenged the denial in tax court. She also filed a motion to declare basically Internal Revenue Code section 7443F unconstitutional. This provision states a tax court judge may be removed by the president only for inefficiency, neglect of duty, or malfeasance in office. Now, she argued this for-cause restriction impermissibly restricts the president's Article 2 removal power, violates separation of power. So she sought to strike the provision and request a new hearing before a different judge. The tax court denied her motion on December 27, 2023. Okay. Now, on the other issue, the tax court affirmed the IRS denial of innocent spouse relief, finding Ms. Wright failed to satisfy any Section 6015 requirements because deficiencies were all entirely traceable to her own Social Security benefits. She appealed both issues to the 11th Circuit, right? So she argued the tax court erred by denying relief on finding a joint return validity without finding if the joint return was valid and challenging Section 7443F's constitutionality. Okay, so the 11th Circuit said, well, we look at abusive discretion for equitable relief denial. We look de novo, basically, from the start for any law questions and for clear error on facts. Okay. Now, general rule, if you file a joint return under 6013 D3, spouses are jointly and severally liable on a joint return. Now, 6015, which is a spouse relief, where she's trying to say no, I should get relief from paying these taxes. It provides conditions. Under 6015B relief, it's underpayment attributable to erroneous items of one individual. The other individual did not know or have reason to know. It'd be inequitable to hold that other party liable. Remember, this is the erroneous item was her Social Security. Okay. 6015, separate liability relief. For deficiencies, if you are separated or not in the same household, you allocate items as if you filed separately. Remember, the issue here is her Social Security income. And finally, 6015F equitable relief, if neither one of those two apply, 6015B or C, it'd be inequitable to hold the individual liable. Revenue Procedure 2013-34, Section 4.01, Paragraph 7, states relief is only available for the portion of liability attributable to the non-requesting spouse. So again, in all three of these cases, the IRS position is pretty simple. This is her income, right? It's her income. End of the day, that's what it is. The court properly denied relief because those deficiencies were allocated solely to her own income. 6015 relieves you of liabilities attributable to your spouse's income, not your own. And let's also remember a little detail here. If she didn't file a return for those years and those returns weren't hers, she's still liable for that income, for tax on income. Okay. Now, she was arguing that the court first needed to determine validity of the joint returns first, but the tax court, no, they're not required to determine validity to deny relief. She was taxable on her own Social Security under laws imposed by Congress, Section 86 specifically, regardless of her filing status. So the issue is she owed tax on income. In fact, there's a real good chance that arguably she owes less tax, by having the married filing joint filing instead of having married filing separate, based on that and his income, right? Validity of the returns is a merits issue. It's not jurisdictional, right? The tax court had jurisdiction under 6015E because she was asking for relief under 6015E, to overturn the IRS denial of, relief for, innocent spouse. An innocent spouse, everything she asked for relief required that it be on income that wasn't hers, and this was her income. So that's a different issue, right? Now, what about her constitutional challenge? The tax courts, tax court judges have to be thrown out, right? We need to restart this, giving the president a right to fire who he wants because, the provision in Internal Revenue Code 7443F is unconstitutional. It violates separation of powers. Now, here's the problem. Courts don't like to decide constitutional questions if they don't have to. And the court said they aren't going to touch this because there is a longstanding doctrine of what the court calls constitutional avoidance. The court will avoid a constitutional question unless it's absolutely necessary to decide the case. A constitutional issue that is wholly academic will not be decided, and that is if no additional relief would have been warranted. She has to show that there would have been relief, right? So she's relying on, and they're relying on Collins v. Yellens, a 2021 Supreme Court case, 141 SCT 1761. To obtain relief from an unconstitutional removal provision, the party must show it inflicted compensable harm, right? In Collins, the unconstitutional for-cause removal of the FHFA director did not void the agency's actions because official was properly appointing unlawfulness provision did not strip their power. There are two scenarios for compensable harm from Collins. The president attempted to remove an official but was prevented by a lower court, or the president publicly expressed displeasure and asserted intent to remove but for restrictions. In these scenarios, the challenged action would not have occurred but for the removal restriction. In this case, in Rodriguez versus Social Security, unconstitutional provision does not affect the underlying agency official's authority to act, as it does not implicate the appointment if the officials were properly appointed, and there's no indication there was any consideration of dismissing them. So they're saying no president said, I wanted to get rid of your judge. Either tried to and the court prevented him, or said he wanted to do it, but the law prevented him from doing that. So you couldn't show that, in fact, that judge wouldn't be there. Nobody had said, I did try to dismiss him and the court stopped it, or I wanted to dismiss that judge, but, I knew the law was there. There was no evidence that a president would have dismissed this judge and the judge would not have been in his position, basically, but for this unconstitutional restriction, or supposedly unconstitutional. The court wasn't going to go look at that issue, right? Since she failed to allege any harm caused by 7443 that would have entitled to relief, that her case was heard by a judge who wouldn't be there, and it was only there because the president was stopped from firing him. That gets it, right? She didn't argue the tax court judge was improperly appointed or lacked lawful authority. And there's no evidence any president during the entire time this judge was in the tax court had ever attempted to remove the judge or express disapproval decisions. Those are things she had to show. And she failed to demonstrate any causal relationship between 7443F and the tax court ruling she sought to vacate. She did not contend a different decision was possible without that provision being there. For all that reason, there is no relief there, so the court's not going to consider that issue, right? So because she didn't demonstrate the compensable harm required by Collins, we're going to ignore that. Final ruling, not going to answer constitutional question. We affirm the tax court determination. Now, the implication. For most instances, spouse relief, your penalties for it's primarily for liability stemming from the other spouse's income, not income of the requesting spouse, right? And constitutional challenges require the high bar, and you must demonstrate concrete compensable harm flowing directly from the constitutional infirmity. As the court said, this cannot be a merely academic question. If it is, we're going to wait until somebody comes before us who has actual harm, and then we'll decide the case. But you didn't show us any harm, because you didn't show that any president had been prevented from removing the judge that you had. And because you hadn't shown that, right, basically it doesn't affect the power. Only if a president had tried to remove that judge and been prevented from doing so, or had, said he was going to remove him, but he knows that code section is there, but otherwise, he'd remove the judge, you're out of luck. This has been the current federal tax developments for August 4th, 2025. Current tax developments, as always, are brought to you by your state-sized CPAs. Now, as I note, I am available on certain listservs or basically connect sites for state societies. That includes the one for Arizona, New Jersey, Idaho, Illinois, Minnesota, and Washington. So if you're there, you have an issue, you can post something there. And if I see it, I'll try to see if I can answer and help. If I think it'd be helpful, I'll try to respond if I have a chance. Okay. Otherwise, we're now going for another week, right? We're going to go now. Next up is August the 11th, right? We are going to start getting, as you become aware, this is August. September is coming up, guys. And obviously, as September comes up, we are going to have we're going to have the first drop dead date for calendar year entities for partnerships on September 15th. So we're going to keep that in mind. But otherwise, we're going to keep our eyes going on what's developed. We had a lot of developments this week. Actually, quite a few came out this week. We'll see what happens in the future. We'll also start waiting and hope to see some guidance from the IRS about provisions in the One Big Beautiful Bill Act. I've been asked multiple times about whether a entity that has, research expenditures under 174, can they go ahead now, if they're a small business, they qualify under the small company exception, can they go ahead and amend their prior returns or amend two of them and then just do the 24 return on extension, assuming they can fully expense domestic activities? And, we need IRS guidance in that area. My own take, I was looking at it this morning, is that provision is probably self-executing, but there's always a chance a court might find some reason why it isn't. So there is a risk filing now, and it's got a weird rule that requires you to amend a return, which if you take that literally means you couldn't file a 24 return, just expensing, because if you did that, the original return was expensing, then you didn't actually file an amended return. And we don't know how the election needs to be made, because that's part of the question there, is the election needs to be in a form, that is, as specified by the secretary. So yeah, we're hoping we're going to get guidance on things like that here real soon and not later, but we'll keep our eyes open. So otherwise, we will see you next week with more coming from current federal tax developments.